Okay, here's some really interesting stuff. Let's talk about some of the standard financial ratios and what they mean. There's all sorts of good information in here for sure. So financial analysis really is important. Understanding just how we're calculating them and what they mean will give you all sorts of insight into businesses and how they're doing. In some companies, in their annual report to their shareholders, they'll actually have a special section where they go through those numbers and analyze them. And basically they're trying to let you know that they think they're doing great, and they're going to tell you why in that section. Now, lots of times we can see ratios where they're measuring the ability to be able to pay their current liabilities or to sell the inventory and then collect the money that they are owed on those sales. Sometimes we'll look at measuring the ability just to pay their loans or their long-term debt, and profitability, just how profitable are they. And finally, then we look at analyzing shares as an investment. We did that before in the earnings per share, but we're going to have another look at that. So when we're looking at their ability to pay current liabilities, or in terms of liquidity, we look at something called working capital. And working capital is specifically the amount for current assets less the current liabilities. It's a short-term measure of what you have to pay in the next year with what you have to pay, what you can use to pay next year's costs with. So that's an important measure of just how liquid a company is. So in this case, both companies have 120,000 in working capital. One has 272,000 in current assets and 152,000 in current liabilities. And this one has much bigger numbers. So their working capital is a percentage of current liabilities, much better in this Blizzard heating than it is in Sunny AC service. They have less room, or they have more room, I guess, just in terms of they have way more current assets than they have current liabilities. These guys, those numbers are bigger and closer. So if we look at it as a percentage, for sure, it looks like this one would be in better shape. That's for sure. But current ratio, and look, that's what this talks about a little bit, and asset test ratio are two very important measures of liquidity. So here's an example. We've got Blizzard heating. It's doing relatively well, fairly stable sales, good margin. Looks like, get down the bottom here, profit. Yeah, profit's up a little bit, looking pretty good, sort of thing. It's improving. When we look at their financial statements, and specifically in the assets, we got more assets, and in terms of current assets, we're growing. Fairly stable here in terms of inventory, but looks like receivables are up a little bit here. And we've obviously invested more into property, plant, and equipment in this case. Looking at the liability side, looking fairly stable there in terms of current liabilities. Total liabilities are up, and specifically in long-term debt. No doubt that's consistent with the increase in property, plant, and equipment. And again, we see fairly stable, or maybe even a little bit of improvement in the shareholders' equity from 320 to 356. So looking pretty good. Now, when we talk about current ratio as opposed to working capital, it's a ratio of the current assets to current liabilities. And again, we're looking at that, and we can say, well, based on the year, how are we? How does that ratio look? And then we can also use that ratio and look at the industry average and say, well, what is it supposed to be? Or what is it in the industry right now? A good ratio would say that there's lots of liquid assets, and we can keep going with what we're doing. But if it gets, it could be that if the ratio exceeds 1, that's great. That might be normal for companies. But it just depends on the industry, and it depends on the particular company as well. Some of them are very efficient and don't need lots of working capital or high current ratio. The acid test is a much more immediate sort of measure. It's really we're looking at whether or not they've got enough short-term money to pay their current liabilities if they're forced to do it. So we're taking cash, short-term investments, and net current receivables, and we're putting that over current liabilities. And what it does is it measures and says, well, how if we turn these all into cash, could we pay our current liabilities if we were pressed? And you can see in 2020, the number is yes, they could do it. 2019, they couldn't. They were a little tougher, and they appear to be way better than the industry average, which is only 0.6. So they've done well, and so we would be pretty happy with this company, relatively speaking. So there's a couple of things that we can look at in terms of inventory and receivable collection. Some 3 important ratios we're going to take a look at for sure, especially if you're a merchandiser. In other words, you're buying a product and then you're reselling it. It might be a clothing store, you might be a gas station, you might be a bakery or something like that. All of these things are you create some inventory and you sell it, and you sell it on account sometimes in terms of creating receivables. So let's have a look at these ratios. The inventory turnover ratio is a measure of how quickly or how much of your inventory is going out each year, how many times you bring in inventory and then it's gone and sold. So the formula itself is cost of goods sold over average inventory. And that might be the inventory at the beginning of the year and the inventory at the end of the year. And then we get the cost of goods sold right off the income statement. So it tells us in this case, the inventory is turning over 4.58 times. If the industry average is 14 times, then it's not turning over as often. So that might be a little bit of concern then in this case. We want that inventory number to be as high as possible, because every time it turns over, we're making a little bit of profit on it. So if it turns over more and more, we're making more and more profit. So 4.58 times a year, not great when compared to the industry average of 14 times. And then receivables, same sort of thing. We're measuring how well we collect our cash from our customers. So the accounts receivable turnover is net credit sales over average net accounts receivable. So you can see it can be the beginning of the year and the end of the year, and then the income statement. Again, if it's all credit sales, it's easy to get that number. And it tells us how many times, again, we're turning over accounts receivable. So how many times are we selling something on account and getting paid in a year? 8.62 times it might be good, but in this case, compared to the average, it looks like it's 22.2 times. So again, not as good as it could be with the industry, but maybe that still works good for this company. We don't know. So, but something to look at for sure. Yeah, it would be important to understand why for sure. Now, when we get to days sales and receivables, this is really going to tell us how long it takes to collect our sales. And we measure that in terms of days, for these receivables. So the calculation, first of all, says, well, what's 1 day sales? So you take the sales number and basically divide by 365, and that tells you how much you sell in a day. And then if we take that day's sales in average receivables, it tells us how many times we're getting those receivables collected. So in this case, here's the calculation. Average net accounts receivable over 1 day's sales. So if our receivables are pretty high relative to the denominator, it can be discouraging. So in this case, their receivables are 42 days to collect, where the industry average is about 16 days. So these guys take longer to collect their receivables, which is not good, because you would rather have cash than having receivables if you could. And here's some ideas on how you can reduce that: offering discounts, tightening credit policies so you don't sell to bad customers who aren't going to pay, and chase your receivables more aggressively, for sure. Now, here's another one. This is a solvency um, uh, ratio. It sort of looks at the ability of the business's ability to pay long-term liabilities. We're going to talk about debt ratio and times earned ratio. So the debt ratio is total liabilities over total assets. As a percentage of the total assets, again, tells you if we got lots and lots of leverage, or leverage being lots of liabilities, relative to the number of assets. And you can see in this case, it's gone up. So it's not good. We'd rather not have too much debt if we don't have to. And in this case, the industry average, though, is a little bit higher. So that's telling us that we're doing better. If our liabilities are lower, or our ratio is lower, that's good news, because we beat the industry average in this case. The times interest earned ratio, it's kind of an interesting one that looks at how our interest costs are relative to our income that we make. So if we've got $34,000 of interest costs and we made $111,000, well, we made 3.26 times our interest costs, which is great. And we look at that in 2019, it was 2.79 times. Okay, well, it's better. We're making more net income relative to the interest costs than we were in 2019. And looks like we're doing better than the average too. So that's great. That's good numbers there for sure. Yeah, it's a favorable sign, and for sure we do that. It looks like it's well positioned to service its debt and pay its bills, sort of thing. Now, there are a couple of other profitability measures. We've seen some of these already: return on assets and return on common shareholders' equity, and earnings per share. We've seen all of those already in previous chapters, but let's have a look at return on net sales to begin. So this ratio, what we're looking at here is what's your income as a percentage of sales. So if your income is relatively large, that's great. That you'd like to have more of those sales leak down to the bottom line if you can. So in this case, 5.6% of the sales end up as net income. In 2019, it was only 3.2%. In the industry average is only 0.8%. So this company is doing well. It's translating a lot of its sales into net income on its bottom line. So it's good. So when we look at return on total assets, we did this before. Net income plus interest expense over average total assets. Again, it tells us how much money or what sort of rate of return we've got between creditors and shareholders. So it's pretty good. And the common shareholder equity, we looked at this before, where we take out the preferred dividends from the net income and just look at the average common shareholders equity. And in this case, it's 14.2%. The industry average is 12.1%. So it's better profitability, better return than we would have seen in the industry. So that's good news for this company. And then return on equity, well, that's where we're looking at borrowing or leveraging. It's an excellent sort of measure of profitability for sure, but more than anything, it looks like it indicates whether or not we're doing a good job of having enough debt and enough investment in shares. It works out very well. So earnings per share, we've already talked about this before. Net income minus preferred dividends over the weighted average number of common shares. An excellent measure in terms of on a per company basis or by company basis. Easy to see, and you can see in this case they've improved their earnings per share to $4.80 from $2.60. That's really good for sure. Now, when you think about shares as an investment, there's really two parts in it. And you guys do all this work on dividends. We see those dividends being paid out in the questions that we do. Well, that's one way a shareholder gets money back, is gets some cash and dividends. Another way a shareholder wins is when they sell some shares, and if they sell them for more than they purchased them, that gain is also a return. So we know that investors are always interested in the book value per common shares because they want to know about, from an accounting perspective, how they're doing, how the company is doing. It's a really interesting way to look at things, and you'll see a lot of investors who think that's a really good way to look at it. Price earnings ratio is another ratio, and it's kind of an interesting one because it looks at the market price versus whatever the earnings are per share. So here's one where we've got a company, the market price is $50 and was $35 at the end of 2019. So in this case, market price per common share was 50 over the earnings per share, which is $4.80. So as a ratio, that's $10 or 10.4. 2019, it was 13.5. So we don't have as much market price there. So they're selling at 10 times their earnings, where they were selling at 13.5 times their earnings before. Very interesting that the market is requiring them is accepting sort of a lower PE ratio in this case. So dividend yield is another way to look at this. If you got $1.20 a share in 2020 and $1 in 2019, well, is that good or bad? It looks like it's not as good, but we have to look at it relative to the market price. So in this case, you can see the dollar that we got when the share price was $35 is 2.9%. But in 2020, when you got $1.20, you got more money. Well, the market price was much higher, and we only got 2.4%. So it's not as good for sure. Book values are all about book values, right? They're not about fair market values. And so when you look at book value per common share, again, it's a good measure of sort of what the numbers look like on the financial statements. But it does have some shortcomings because it doesn't recognize market value. But that's hard to determine sometimes in terms of a company's assets. Really hard to do that. Now, there are lots of business decisions that we can make here based on financial analysis. And it sometimes is helpful. It tells us if there's something going wrong, or, can give us some sort of indication maybe how we can correct it. But financial statement users use that data all the time in light of other information. We might have some press releases saying we just got a new vaccine for COVID that we developed. Well, who knows, right? You've got to look at these ratios over a number of years. You can't just take one period. You need to look at trends for sure. There are so many things to look at, and understanding in the market why a company's doing what it's doing. It's really important just to have a good overall look at it. In this case, here's one. Current ratio is down. Well, we know that the current ratio is current assets over current liabilities. Well, why is that? Why has that happened? Well, is there a cash shortage? Have we seen receivables go down? Inventory too low? All sorts of really good questions there that you'd like to ask the company if you could. And then we can also get other information in the president's letter to the shareholders, management's report to shareholders, the MD&A, auditor's report, all sorts of good information. We often see this stuff in annual reports, sort of the once a year that the company sort of says, here's everything that's happened in the last year and where we're planning on going. It's really good information. But here's some red flags for sure that you should look at. Any changes in sales, inventory, receivables, sure. All these things, earning problems, on and on and on. They're all excellent things to look at. And I think that's all we're going to do on this for now.